we're way off the lows on the Dow, as you saw there. Let's do our calls of the day. JP Morgan today says Amazon's going to pass Walmart as the largest U.S. retailer in the U.S. in 2024. They reiterate their price target of $240, and they say overweight. This is about 30% upside. Kevin owns Walmart. Farmer Steve owns Amazon. Do you guys want to kick this one around a little bit? Does that matter at all to either of these stocks?
Are you
this
asking,
call by JP Morgan?
Well,
so if Amazon becomes the largest retailer in the U.S. this year, does that mean the stock is going to do meaningfully better than what Walmart will do as a result of that?
Okay, right. Thank you for putting in that context. I don't look at this as a pair trade. I don't look at this as long Amazon, short Walmart. Some people may, but look, Amazon is far more than retail as well. But obviously, it's a retail juggernaut. It's also got Amazon Web Services. It's got logistics. It's got a lot of other shots on goal. I think actually the multiple going forward on Amazon is attractive. I know it's roughly 40 times forward, but I think they're going to out-earn that. And you're going to see that's a low 30s, actually maybe high 20s multiple. I mean, we'll see on that. But by the same token, I don't think, Rob was talking about a somewhat compromised consumer. That plays very well to Walmart. So I don't own Walmart. I'm not that jazzed up about it. Kevin can make the case, but I don't look at it as a pair trade.
Well, I think it's interesting when you look at the performances of both names that year to date, Kev, your Walmart is up 27%. Amazon's up 21%. They've obviously both done well. They've both outpaced the market. What about this call and your view on Walmart?
So Jim's right. It's not an either or trade. I mean, if I'm an investor that has the ability to own both, I absolutely would. We're a dividend shop, so we're going to lean into Walmart because of the dividend. I was hoping and praying that Amazon would announce a dividend so it could get into our board. But this is a scenario where the market cap's less relevant. It's about the forward earnings, and I think that with respect to Walmart, they've gotten back to a margin level that they saw before COVID. If we do go into an economic slowdown, they benefit from a consumer trading down a little bit. And they are doing the best that they can to compete with Walmart in terms of online and advertising. I like both stocks here, Scott.
How about Roblox, Bryn? Initiated outperformed today at Macquarie. Price target's $46. Building blocks of the metaverse. Those are the words that Macquarie uses today to describe this name.
I mean, we've gotten 2 upgrades in 2 days on Roblox, so it's been nice. So I think what you've been seeing, if you listen to the earnings call and what they mentioned, is that this company consistently over the past 7 quarters has had double-digit bookings growth, and year over year they've had 22% revenue and bookings growth. So the point is that this is a sticky company from that CAGR. And I think that the overreaction we saw when earnings came out, when it was down almost 30% in a day, it went from 42 to 30. I added to it at 31. I think it's going to fill that gap and go back up to 42. But it's just, this is, to me, within the gaming, you have Asia, you have India, you have a really growing base internationally. And I think this Macquarie is seeing that and say, hey, this is a sticky name in the gaming universe.
Jimmy, BofA says you may want to get ahead of 2 key events for Citi this month. The Investor Day on June 18th, that's next week, and the stress test results on June 26th. So then you could start talking about capital return again, and that part of the story. Their price target's $75. It's at 59. What do we think?
Well, it's no surprise. I totally agree.
But you can agree, but think that 75 is maybe a little aggressive or not.
Well, here's why I don't think it's aggressive, is because tangible book value per share on the stock is in the high 80s, roughly $88 a share. I submit to you and to everybody watching that there is no good reason why Citi trades at a discount to tangible book value. I'm not suggesting it should trade at a multiple like JP Morgan. It's not JP Morgan, but it should trade at tangible book value, which would put it in the high 80s. The CCAR results could, Scott, to your point, increase the capital return, although the share buybacks are pretty prolific right now, and the dividend's pretty nice, but still, it could increase the share buybacks even more, and I love that they're buying back shares well below tangible book value. I am long and strong on Citigroup.
Why the bad week, Rob, for financials? It's as I said earlier, it's the worst performing sector. You've got JPM, Wells, MasterCard you can throw in there, but what about the banks?
I think a lot of people were hoping that the yield curve would start to steepen and take pressure off net interest margins, pulling money from money funds and back into deposits, and that's just not happened. And so the yield curve remains more inverted, and the Fed is theoretically staying higher for longer, and so that's put a lot of pressure on the banks. That's why we're sticking with the highest quality of the group. We don't think you're going to get the support of the Fed for a little bit. A bank like J.P. Morgan has done a little better because they've been their banking-related results have been extremely good. Wells has lagged a little bit. We did trim Wells, Scott, if you remember, on the show by about half the position. It's down 15% since we trimmed it. Wish we would have sold more.
When does someone on this desk buy PayPal once again, Bryn? Because the stock's down 8.5% week to date from, darling to outcast. Feel like everybody loved this name. During the pandemic, I want to say that this stock had a larger market cap than Bank of America. And here we are, how the once mighty have fallen. When does somebody say enough's enough and I like this name and now I'm ready to buy it? And I'll ask you that question.
Yeah, Venmo, let's talk about, Venmo is such a juggernaut, right? Which, don't forget, that's PayPal owns that. I think it's got high free cash flow. It's got solid earnings. It's like there's no interest in the stock, and that's where it's so important. You can have strong fundamentals, strong earnings, free cash flow, but if there's no buyers, it's not going to go higher. I think that people think this is somewhat of a commodity. And so I think the Apple news just puts another, nail in that coffin, that people view this business as commoditized. It's cheap, but I don't want to buy a name that I think that no one else is buying, because ultimately flows are what make a stock go higher.
Okay.